It is time to talk personal finance thanks to our partners Forsyth Barr. Volatility in the markets will be a given for the foreseeable future as the war with Iran continues. So what does this mean for your KiwiSaver and your personal investments? Brad Gordon, Senior Investment Advisor at Forsyth Barr, is with me at the desk. Brad, good morning.
Good morning, Ryan.
Good to see you as always. Now, how tied are our KiwiSaver investments to whatever outcome there might be in the Middle East?
Oh, for sure. Growth investment, KiwiSaver investment funds will have a lot of money in offshore securities, which will be impacted by global oil prices. Now, you don't have to be just in offshore equities to be impacted by global oil prices. That affects everyone every day. Oil prices have long tentacles, and they come into everything from our food, our transport, and everyday living costs as well. So, but when we talk about exposure to oil companies, you actually may find that most KiwiSaver funds have very little, and that's because oil doesn't pass many KiwiSavers' environment, social and governance, ESG criteria, so they actually filter out oil companies per se. So oil companies are actually benefiting, or certainly those oil companies that can get product to market are benefiting from a higher oil price right now, but not all KiwiSaver funds will have any oil exposure.
Two things. How much, if you've got investments, how much could you lose? I guess that all depends on when things turn around, right? How long does it take before things do turn around?
Yeah, all we can do is look at past history and similar type events, and in the last 15 years or so there's been two similar events. One is when NATO went into Libya and ultimately ended Gaddafi's regime. Very, very similar to the situation today. Libya, an oil-rich country. That had a short-term effect on markets. By the end of 2011, there was other issues such as the US debt ceiling hitting markets and things. But the S&P 500 ended that year flat, despite some short-term volatility. And then we bring it forward to when Russia invaded Ukraine back in 2022. Again, at the same time as that happened, we were seeing interest rates rise already globally, and so that had a reasonably significant impact on markets, but again, relatively short-lived. Markets are much, much higher than what they were in 2022 now.
And long-term, that's a very different story, isn't it? When you think about a longer-term investment, you're not so worried about these more short-term blips.
Look, as long as you've got a 7+ year time frame before you need to access your KiwiSaver, and when I say access your KiwiSaver, the most prudent strategy is when you turn 65 is you turn on a regular income stream from KiwiSaver, not necessarily cash it in and take it all and put it all in the bank. Turn on a regular income stream. Therefore, even at 65, your time frame, your investment horizon is still long term. We are still expecting, well, life expectancy is still around about 80 or 80 plus now. So keep a pragmatic long term horizon. Then you don't have to worry about too much about the short-term market movements, though they are settling, and you should take the time to think about things.
Should you think about retreating to a conservative fund? Is that ever a good idea?
Hardly ever a good idea, because market timing is impossible. We went to bed on Monday of this week with the Dow futures down 1,000, and we woke up and the markets were higher on the back of Trump's comments that this war is going to be potentially relatively short-lived. Who knows? We need to watch that further. But market timing is virtually impossible. So always have a goal on your horizon and seek advice. Talk to someone before making rash moves. But thinking that you're going to move your KiwiSaver fund from a growth strategy to a conservative strategy when the markets have dropped 5 or 10% is not necessarily a good move.